Happy Wednesday, everybody. Thanks for taking some time out of your day to join us. Myself, Tim Kraus, here with Financial Brokerage, and Tom Brown with Corebridge Financial, formerly AIG. I'll let Tom formally introduce himself here in a minute. Just a couple quick things to kick off today's presentation, a couple housekeeping notes. On the right-hand side of your screen, a couple things to point out. First thing is you are on mute and will be on mute throughout the presentation. That helps us keep the audio clean so everybody can hear clearly and avoid any incidental background noise. But just because we have you on mute doesn't mean that we don't want to hear from you. If you have questions or comments, on the right-hand side of your screen, you'll see a box labeled questions. Throw any questions or comments that you have in there. I will see those, and then we'll be able to address those during the presentation. Another thing I'll just point out before I forget, because sometimes I tend to do that, I have attached a couple of handouts for you on the right-hand side of your screen under the handouts box. They are two client-facing pieces. One's just kind of a flyer piece, and one is more of a brochure that you'll be able to use with clients that relates to the presentation that we have today. So hopefully everybody's enjoying the nice weather, maybe after the presentation today. I know we've got a baseball game tonight in Nebraska. It'll finally feel like spring instead of the late winter that we've been having. Now the presentation today, this concept in particular, I first saw several years ago, and it stood out to me as being one of the most simplified explanations on how to educate your clients on why they might need life insurance all the way through retirement and that permanent protection. And a lot of times when people think of permanent life insurance and retirement, they might think of a supplemental retirement concept, which is something that we probably were all trained on early on. Great concept for the people that it applies to, but this concept is more of a protection-based concept. We do a lot of term insurance here at Financial Brokerage. I'm sure a lot of you on the call sell a lot of term insurance. It's a great financial tool for protection, particularly for people protecting during their working years. But what happens after those working years? Do people still need protection? The answer, obviously, is yes. But how do you explain that to your clients? Well, what Tom is going to share with you is something that's been developed by Corebridge and is one of the best ways to explain it to clients that I've seen. So I'll shut up now and kick it over to you, Tom.
Thanks, Tim. Thanks, everybody, for joining the call. Hard to believe it's May already, and we'll be talking Memorial Day and start of summer here in no time. And like y'all here, I'm based in Dallas. I cover 7 states for Corebridge, formerly AIG, Life and Retirement. So I'm based in Dallas. I covered Texas, Louisiana, Oklahoma. And then in 20, right before COVID, I picked up Missouri, Nebraska, and Arkansas, as well as Kansas. So big territory, but in Dallas, we're the same thing. We were sunny. We're 73 already, supposed to hit 79, 80, something like that today. So perfect spring weather. Because I know by the end of the month, by Memorial Day, the oven will be warming up. I already was talking to Tim before. We're supposed to have some 90s by the weekend, 90, 93, and before it goes back down into the mid 80s again. So, but it's nice, and at least it cools off at night, because the knock in Dallas is once you get to the summer, you have those upper 90s and low triple-digit temperatures. But the problem is with all the concrete, it stays that temperature. Even 10 o'clock at night, you still have 98 degrees. And they say it goes down to 78 or 80, but that's for like 5 minutes at 4 o'clock in the morning, and then it goes right back up again. So I'm enjoying it while I can. Again, thanks for joining the call today. I'm going to show you some pretty cool ideas, starting with this butterfly chart. We're going to cover another topic called Who Do You Know, which pairs really well with the butterfly chart. A little update on AG 49A revised, which just went into effect for illustrations of IUL in May. And then open up to Q&A, and if you have anything, please put it in the chat box or let Tim know. We can answer those along the way. So with that, I'm going to get started. So first presentation, We have one of our keynote speakers that's been Joe Ross for us that's talked about this. He's developed this. And it's just called Understanding Life Insurance with the Butterfly Chart. And what's great about this presentation, it's something that you can use for consumers because it's consumer approved, and on Retire Stronger, which I'll mention at the end too, our website, and Tim can send it out to you. We have a whole plethora of information on the Butterfly Chart. We have this PowerPoint deck. We have a 10-minute video of it by Joe Ross. We have a napkin idea, which is like I would call it a foldable 8.5 by 11 piece of paper. If you print it, you can fold it and makes a napkin sales idea with what we're going to go through today, as well as a PDF with the speaking notes. Have that as well too. So a lot of content on this, and we've been doing a lot of the blocking and tackling type presentations where years past everybody wanted the highest end sales idea. What's the latest with split dollar deferred comp, and now we've gone full circle more back to the basics on why things like term versus perm matter, what's the importance, and again, how to explain it to consumers, how to explain it if you have any centers of influence that may refer your business or people that just really don't know a lot about permanent insurance. So with that, I'll get started. And with the deck, there's all disclaimers so I don't go to jail. So we call this the financial risk spectrum. So you have your 20 to 40 years prior to retirement. And retirement age could be, whatever your client retires. It could be 55 or it could be 70 or older even these days, right? But somewhere in that range. But usually, generally, it's that, 65 to 70 range is where you see most people. If you're really lucky, you can retire at 50, right? But there's two periods of time. There's the years before retirement and the years post-retirement. And before retirement, there's three big risks that start off large and it gets smaller over time. And these are your typical insurance needs that you usually see out there in the marketplace that people discuss when they say, hey, I'm a life insurance agent, or here's how I help people. And what you have, the three main needs are, one is education savings, because it might not just be college. Maybe you send your kids to private school too. So maybe you're funding it or saving for it all along the way, or maybe private high school, but definitely for college. So everybody, when they start to have kids or think about having kids, they start putting away money for college. The other thing is mortgage and debt. So usually earlier on in your career, you buy a house and maybe upgrade to a bigger house, but it starts off earlier in your lifespan. You have the big mortgage, and hopefully by the time you get to retirement, you pay that house off, or even if you downsize, you take the money from that bigger house, move it to the smaller house, and it's still paid off. So you pay off your mortgage, pay off your debt. And then in the early years, you have a need for income replacement, even if the spouse isn't working, if she's working in the home, which is one of the toughest jobs out there, right? Helping with children. If she happens to pass away, you need income to have, nannies and daycare and those type of things. Or if she adds to the household, you need to replace that income because you have that shortfall when she passes away. Again, the risk and need for that is the greatest earlier on, and the closer you get to retirement, the more it diminishes. So again, kids at college, pay off mortgage and debt, income replacement. That's how people factor in most needs analysis. Even if you do a complex financial profiles needs analysis, those are the three things. And that's how come you hear people say 5 to 10 times income, those type of numbers. They all usually generally cover these three issues in life. So again, they start off larger. It's the left half of the wing, if you will. If you were a butterfly, if I was to stand in the middle, I would look like an angel or a butterfly with the wings. So on the left side, you have those three. They get smaller over time. And what do we use to address that most of the time? The easiest way is term insurance. So people look at 20-year term or 30-year term or 35-year term and say, look, if you buy the term now, by the time you retire, it expires. And look, you're good, you're covered. And then the clients always go, well, I don't need any insurance then I'm good. Once I'm retired, I'm all set. Kids are off to college. They didn't move back in the home, hopefully. They have their jobs, their families, their career. Mortgage is all paid off. I'm good there. And I had a nice savings between my 401k and my investments. So I don't need to replace the income because that's saved. So I'm good. I use the insurance if something were to happen to me. But what they failed to realize, and what's often not talked about, is what happens about the three big risks once you're in your retirement. So the first one that comes up is financial risks. So everybody goes, well, what are financial risks? First, you have stock market correction. So imagine if you're 80 years old and there's a correction. How long does it take to recover from that? And odds are what you see over time, there's a stock market correction almost every 7 years. So if you have that every 7 years, it's not a matter of when, it's a matter of if. And how many of those corrections may you have in retirement? You might have 2 or 3 corrections during retirement. So how do you compensate for that? How do you adjust for that? Because you can't predict when it's going to be. Maybe it's early in retirement, you can survive because you've got a long time. But if it's later in retirement, can you recover from that? Then you have home ownership expenses. So now you did a great job, you paid off your home. But what about things like your HVAC, right? Your heating and air conditioning, that goes out. Maybe you need a new roof. Maybe you need new windows. Maybe, God forbid, you have a foundation issue. You need a new fence. Maybe you need a tree move. That small tree now is a huge tree and the roots are growing into the foundation or something, or your basement, or something's happening there. Any of those costs that you have, maybe you just want to upgrade it for the latest technology. Maybe you want to put USB ports in all over the place, or the latest Bluetooth or Wi-Fi system in, and that costs money. And again, the longer you live, the more issues are going to arise from your home over time. So what do you do? And then if you have a pool, even more so. So you have home ownership expenses. Then you have the low interest rate environment. So right now the rates are creeping up a little bit. You can get annuities with higher rates, whether they're in the 4% range. So it's still better than where it was when everything was at close to 0 or 1%. But is it still keeping up with the cost of eggs, the cost of gas, the cost of beef, cost of corn products, any of those type of things, or cars? Is it, if you put everything in the bank or in your mattress, are you keeping up with inflation? And right now we're still not keeping up with inflation. So where does that go? So that's another risk. The longer you're in retirement, the more that impacts your retirement growth. And odds are people have a little mix of stock market and bank or CDs, those type of things. Then you have increasing tax rates. So you ask your customers, where do you think taxes will go? Everybody, 99.9% of the people are going to say, they'll laugh and they'll say, well, it's going anywhere but down. If you look at our debt, there's a website called usdebtclock.org. I think we're at 31 trillion. And I think by 2015, we were like 20 trillion. So it just keeps growing rapidly, more and more rapidly, more and more exponentially. So once your retirement, tax rates are going to increase. So, and they're still increasing. So odds are you're going to have to pay more and more taxes, even though there's great tax shelters you can use to help you with that. Odds are once you're in retirement years, you're going to have more tax burden. Then what happens if you didn't save enough money, right? So you're in retirement and you realize, oh, I didn't save enough. Or you thought you were going to only live to 72 because maybe your parents, God forbid, only lived to 72. So you lived to 72. But now with medicine and lifestyle changes and everything else, now you're 75 thinking you're going to live to 85. Well, what if you didn't save enough money? And then last is, what if you had too much fun too soon? Maybe you retired and you go, wow, this is great. And you travel or do trips or play golf a lot, different activities, join a club, those type of things. And then you spend too much money too soon. Well, the biggest thing that's most likely going to happen once you're in retirement years is a little bit of all these. You'll probably have some of your money in investments, so you have to hedge against stock market corrections. Odds are, if you have a new home, unless you have a brand new warranted home, but even over time during retirement, it will need repairs. So you have home ownership expenses. You're going to have interest rates that are fairly low, or usually not high enough to keep up with inflation anyway. Tax rates are going up. Whether you're super wealthy and it's estate tax rates for your family, or just your regular income tax rates or property tax, those type of things will be going up. And odds are maybe you didn't save enough as you wanted to, and maybe you had a little bit too much fun when you started or somewhere along the way. Well, guess what? The longer you live in retirement, the more that grows and the more it can impact your savings. So then next you have healthcare costs, and everybody looks at healthcare and thinks long-term care and assisted living. But what about co-pays, deductibles, the type of plans that are out there, people that are in that world, Med-Sup world, Medicare, Medicare Advantage, all those type of things, all the A through F options that you have? What if things aren't covered? What if you go out of town? Like I'm in Dallas, and God forbid if I had cancer, I'd want to go get treated at MD Anderson in Houston. Well, I got to fly there or drive 4 hours. Spouse, girlfriend, family would have to stay there with me, hopefully. And there's cost for that. And then what if it's some new treatment that's either not covered or not covered at 100%? Where does that money come from? Or if you're in Omaha and you want to go to the Cleveland Clinic or the Mayo Clinic for heart issues or other issues, who covers that? So odds are that comes out of healthcare costs. Now the good news is, out of your retirement savings, the good news is you have the ability to go do that, and you live longer. The bad news is that you live longer, because now that you've lived longer, the odds ever increase that you're going to need assisted living or long-term care. Where does that money come from? And that's on top of your financial risks that we just went through. And then last At the death of a spouse, you have reduced Social Security income. So a spouse passes away, and then you're going to lose that Social Security income that can drop you, 30% in income from Social Security or so. So you have all these risks that impact a lot of people don't think about once you're in retirement. And guess what happens? Let's say, God forbid, something happens to you, you're 82, 85 years old, and you're on your deathbed. Can you look up at your spouse and say, hey, you're going to be okay, because when I pass away, yes, we spent all this money for financial risks and we fixed the house, and now I was in assisted living for 2 or 3 years, and I'm going to pass away and you're going to have less Social Security income, but hey, we have enough money in life insurance to take care of you. Or we had a policy that had a chronic illness rider that took care of those costs, and when I pass away, the balance will take care of these issues and you'll be okay. Or are you going to look up and go, man, I wish I did some additional planning, or I wish I saved more. But unfortunately, you're going to have to figure out between friends and family and whatever means, maybe having to work to take care of yourself when I'm gone. Which plan do you want to have, and which plan do you want to leave? So what we look at is, why are you covering, when you talk to a client, why are you just addressing the needs for if you die? And the stat is, it's somewhere between 97 and 98% of all term policies never pay a death claim. So even if you were even super conservative and said only 95%, but 95, 98% of all term policies never pay a claim. And that's what we all protect the most, right? If you die, early years, children, income replacement, if you die. But when you're actually going to die and you're going to need it more and more, especially the longer you live, you leave yourself completely exposed. And even along the way before you get to retirement, you're not guaranteed. If you buy a 20-year term when you're 30, now you're 50 and you want to buy another 20-year term, maybe when you're 50 or 55, maybe you can't qualify. That's another thing to consider as well. And if you can qualify, what's it going to get you to? So if you're 50, you buy another 20-year term, because you can't buy really one all the way out to 80 on 30-year term. Usually they cut it off about 45. So you can get yourself covered 70, maybe 75, and that's it. And you're still going to have those risks if you live longer. So this idea that we came up with, and I recommend, what I tell everybody is, hey, come up with your next 3 clients, try this idea, especially if you're often just promoting term insurance. Let's say this client needs $1 million. So you run your $1 million, a 20-year term, 30-year term, whatever you prefer for the client. And then take a percentage, and this one we do 60-40, but you can do 50-50, 70-30. But take a percentage, and this one we said, okay, let's do $400,000 of permanent insurance. And I highly recommend putting some type of chronic illness or long-term care rider, so that way in those retirement years, you can actually have, what I like to say this, instead of having the old insurance, you have the new insurance. And they'll go, what's the new insurance? The new insurance is a type where you can actually use the death benefit while you're alive for your long-term care costs. And what does long-term care usually mean? Inability to perform 2 out of 6 activities of daily living, or some type of cognitive impairment like Alzheimer's or dementia. And what's really funny, sometimes people say, well, my kids will take care of me. And I'll go, have you discussed that with your children? Because it's one thing to take care of mom and dad if all she needs is to go to her doctors, get their medication, buy groceries, and cook their food. It's a whole nother thing if you've got to feed them, bathe them, lift them out of bed, carry them around, do that type of stuff. Or if they have a cognitive impairment and they don't know where they are, or they're losing basic skills, how do you take care of that? It's a whole different ballgame than just being someone who just helps somebody who can't get around as well. So, and everybody I think tends to think that that's what it's going to be, somebody who can't get around as well, but they can feed and do everything else themselves, which usually, unfortunately, is not the case. So in this example, 400,000 of permanent, add chronic illness, and then you have 600,000 of term insurance. And that term insurance, what's nice about that is it gives you the full $1 million of coverage that you wanted pre-retirement. And then in your retirement years, it leaves you with 400,000 for later in life. And guess what? Depending on the carrier you utilize, with us, it works. That 600,000 term, you can convert all or part of that to permanent. So if the clients either become more successful or they deem that they're going to need more in their retirement years to cover these additional risks, they can convert all or part of that term and make that permanent coverage that goes all the way out for the when you die years higher. So maybe they convert 250,000, so they have $650,000 of permanent for the retirement years. It gives you options. So I highly recommend try your next 3 clients that need term insurance, unless it's just tied to a 10-year note or a bank loan. But if it's a true need, somebody has kids and mortgage and income replacement, show them the term insurance, but then go through the butterfly chart with them. We actually have a video that you can actually show to the consumers if you want, if you're not comfortable doing so. And then that walks through this butterfly chart and then show them the combination premium, again, whether you do 60-40, 50-50, 70-30, whatever type of split you want to come up with, to show them to get them some coverage that's permanent, that as long as they pay the premiums that you decide on an illustration, they'll carry forward. So again, we call this the butterfly chart because if you look at it on the left and right side, it looks like a pair of wings. You have the 3 wings on the left that for the if you die years, kids at college, mortgage, debt, income replacement. But what most people don't even consider because they just want to get to retirement is what about financial risks, healthcare risks, and reduced Social Security income. So again, I would try to identify 3 people that this fits. So that's our butterfly chart presentation. And again, on Retire Stronger, we have a lot of content there, and I'll back out of this for a second. And then I will show you another great piece that we have that goes great with this presentation. Bear with me for 1 second. We have this section called Find Clients, and so we have a piece called Who Do You Know? I'll pull this up. So this Who Do You Know piece, this is another great one to go through your book of business and identify 3 people, not per category, but just for this whole entire sheet. And then you could even use tie in a butterfly chart with this when you're discussing it with consumers or with centers of influence. When you're a life insurance agent or a life insurance focused representative advisor, there are really 5 areas that people look at. You have long-term illness expenses, tax diversification, major life changes, small business owners, and legacy planning. That's really the main uses and areas of life insurance. But what's great is the same products address all these needs. So what I highly recommend is you look at long-term illness expenses. Maybe somebody that you know or work with had a long-term care policy, but it's gotten too expensive, or they've quit writing the policy, or they don't cover as much as they used to. Now what do you do? Or maybe they're providing financial support to parents and they don't want their children to do the same for them. Or maybe they know somebody who's in a nursing home and they themselves don't want to be in a nursing home. So all those type of questions that you ask your client can lead to opportunities with products like life insurance, where you can add these chronic illness riders that you can actually utilize anywhere between 50 and 100% of the death benefit to have it accelerated once they can't qualify for inability to perform 2 out of 6 activities of daily living, or have a cognitive impairment like Alzheimer's or dementia. They can utilize their death benefit while they have those issues while they're alive to help address those long-term illness expenses. Ours is kind of nice because it's indemnity. You don't even need receipts. You just got to qualify. And we accelerate our death benefit at either 2%, 4%, or the government max per diem, which is now right around $429 per day. So we do that on an annual basis. So that's something that's nice that you can have. So that's one area of concern. Another area is tax diversification. You have a lot of people that are in their 401ks and IRAs, but they want to save additional money, or they want to have some more tax advantage money, because just like in the butterfly chart, you ask them where taxes are going, and they say anywhere but down. So one idea we have, it's real simple, that ties to tax diversification. We have presentation material on this too. It's called 5, 10, 20. So basically what you do is you draw a 5, 10, and 20 on a piece of paper, or a napkin even, and you ask your client, if you could pay taxes on any one of these numbers, which ones you pay taxes on? Everybody says the 5. Then you ask them, okay, you're saving for retirement. What are you doing for that? And they'll say IRA. Almost everybody will say a 401k. And then you pause and you ask them, well, how is that taxed? Well, I don't pay taxes now. It grows. Don't pay taxes along the way, but when I take it out, it's going to be taxed. Then you pause again and you go, well, where do you think taxes are going? And they'll usually laugh. So anywhere but down, they're going to go up and up and up. Then you pause and then wait another minute and say, well, wait a second. You'd like to pay taxes on the 5, but you're paying taxes on the 20. And when you access that 20, odds are taxes are going to be even higher than they are today. And they'll laugh. Oh, yeah, but that's just what everybody does, right? And then you can say, well, if I could show you a way to pay taxes on the 5 and not on the 20, is that something that would be of interest to you? How much could you put away in a plan like that? Would you like to use that as a supplement to your 401k? Let me put together some ideas for you. And that's, of course, where you can use the cash value of life insurance, where you can access it via loans and withdrawals and get the money out on a tax-favored basis and still have coverage for your family if and when you die. So that's tax diversification. Another easy one, major life changes. They've had a major life change. They're married, they're divorced, new children, more children. Children went off to college. Maybe children are back from college and they're at home. Maybe they bought a new home or moved to a new city, new location. Maybe they've got a new job promotion, or maybe they started a new business on the side. Any of those reasons are one, to visit with them and see if they've, for the least, updated their beneficiaries on everything. So that'll give you access to see what else they have in their both life insurance and investment assets if you handle that. Make sure they've updated that. And then also, if you find out they do have insurance, it gives you an opportunity to review their insurance to see, hey, do you have enough insurance? When's the last time you reviewed the insurance that you have? What's an adequate amount? You can go through the butterfly chart, ties in really well with major life changes. Then you have legacy planning. If you have any high net worth people, generally these people are 10 million plus dollars net worth. They're concerned about getting kids to their next generation, to their children, to charity, those type of things. You can help them with legacy planning. Usually there's opportunities there. And don't assume that they've taken care of themselves, because most people are so focused on their business that they don't focus on themselves. And have they addressed, what happens long-term care wise? Are they covered, or they need some additional money to help with that? Or have they structured their estate in such a way so it gets to their kids and or to a charity on a tax advantage basis, and they can leverage their money to the best of their ability versus letting Uncle Sam take it, those type of things. And then my favorite is small business owners, because small business owners tend to have multiple needs. Not only do they have the personal needs of all the other 4 topics, but they also have the things such as if they're partners in the business, what happens to their retirement if they or one of their partners dies? What happens to the business if one of their partners dies? What happens to the business if they die? What happens to their business if a key employee leaves? Do they need supplementary retirement to help retain and keep a key employee or key employees themselves? If they want to pass the business on, is it going to 1 child, 3 children? The children want anything to do with the business, or is just 1 or 2 kids going to run the business and the other 2 are not? How do we equalize that inheritance so it's deemed fair, so they're not going, so the children who like the business are deemed to be treated better than those who aren't in the business? How do they involve that? And again, what about cost to replace a key employee? What if they want to keep their business family owned and operated? All those type of questions can open up opportunities. And if you don't know how to handle those or address those, the folks at Financial Brokerage can help you come up with a plan, help you with questions, help you with the meetings, all that type of stuff, and coordinate it together. And again, for all of these, the butterfly charts fits, because it goes through, okay, here's what term insurance is going to address to you, Mr. and Mrs. Business Owner. But here's what, when you're most likely going to die, here's how term can help get the business to the next generation, get the business to your partners, not just over a 10-year period of time. So again, we call this piece, who do you know? And I highly recommend, just like the butterfly chart, I like the number 3 because it's a good batting average, right? I know you guys have the College World Series coming up in the coming months in June, right? I believe. So when you have that, if you can identify 3 people that might fit this from your book of business and identify them, maybe go into the butterfly chart with them and look at some ideas, either term perm combos or other things that might come up. And again, if you need help, the people at Financial Brokerage can help you with that. So that's something to really consider. And then we even have presentations that we can do for future webinars. This is one, I'll just tease it up. What keeps you up at night? And this is the one we do on business owners. And it's not one that goes into buy-sell planning and key person and deferred comp and split dollar and all the insurance jargon. It really comes up with questions of, what do you want to happen to your business, Mr. Business Owner? What could happen if you don't do any planning? What's going to happen? And here's an idea you might want to consider that's most likely going to utilize life insurance. So you can look through these main topics. What happens to my retirement if my business folds? What happens if one of my most valuable employee leaves? I'm a sole proprietor. What happens to my spouse's retirement if I die unexpectedly? Or if I have business partners, what happens if I die? What happens if one of them dies? What happens if one of them retires? All those type of things. And how do the employees view the business? If Charlie's the main glue to the business and Charlie leaves, what happens to all your employees? Do they stay? Do they go? Is it free agency? Like football, what happens? So this is a good presentation that kind of walks you through some of those, and you could jump around in those topics. So that's something that we also do that we can always do in an upcoming webinar. So more importantly, though, what I wanted to show you real quick, also, I mentioned to Tim, we have a website, and he'll send you this link when we get done. It's simply called retirestronger.com. And this website, we put all of our information because all the carriers out there have great products. You as agents can position any one of us out there. We're all pretty competitive. You might like others better than one another over somebody else, carrier A over carrier B. We all have competitive products. We focus on term and index universal life for both guarantees and accumulation. And we do have guaranteed universal life as well. We have pieces and sections that are focused on agent recruiting, and that's really to other agents and advisors. That's where all that content is, or centers of influence if anybody refers you business. We have another section, agent development, which really has got a lot of learning, a lot of topics like the butterfly chart in there. And then we have pieces for client prospecting, beneficiary review, policy review, those type of tools. And like I'll just show you real quick here, when you click on these, if you look at, let's say, find clients, right? So I showed you on here, who do you know? So you pull that up, it pulls that piece. We also have a financial wellness checkup. So if you pull this piece up, it launches a PDF on financial wellness. What are your concerns? What's your overall planning? And it just gives you ideas. You don't even have to use a sheet, but you can ask your client some of these questions and they can address, okay, is it important? Is it not important? What are some of their planning that maybe they're going through? And it can open up the doors for some nice potential cases. But even more so, we even have some pieces that are, hey, life doesn't stand still. And you could use this almost as a mailer. Take a moment to life has changed over the last several years, put your information. How long does it take? We can do a policy review. What happens if you misplaced it? What happens if it turns out you have less than what's needed? How can we do this? And this is a service that we provide. So this is a nice piece that we have. And then we have pieces on both beneficiary review, because that's an easy way if you don't want to jump right to policy review, just whenever you update your beneficiary, given all these changes. And then we have policy review pieces. So a lot of good content there. And if you want to cheat, a good one-pager is if you click resources, it allows you to scroll all the way through all of our products, sales concepts, agent, client, business tools. And what's nice about it is when you go through these, it's all organized the same way. So if you want to see our sales concepts, they're all here by product. So here's an example, that 5, 10, 20 I mentioned. Idea, we have that. And then we have all of our pieces under conversation starters. If you click this, we've got sales concept packages, agency recruiting, client emails, generation tools, and business tools. So a lot of really good resources all at your fingertips, and all you got to do is click on the drop-down menu. So here you got calculators, just a lot of good tools that you use. We have pre-built campaigns for all these different topics. Let's say mortgage protection, that you can send and do 4-week campaigns, and it's all pre-built, and you pick whether you want to use our email e-newsletter, whether you want to use a direct mail infographic that you can email, whether you want to have little infographics you want to post on LinkedIn or social media. We have tools on that, and we have it both for clients and we have it for agents and centers of influence. So a lot of good content there, all at your fingertips, really just to help you market to your folks. And we even have a unique tool called Generation Station, which is really nice because what it'll do is if you enter in your client's name, for example, and you pick the age range, and let's just say, I don't know, we'll pick 40, and we'll say they're married, and they'll say a parent, and let's say they have children under 13, let's say they have 2, and here let's say they have none and none here, and their career building, and let's say they make, I don't know, let's say they make 50, 100,000. What it'll do is they'll say what are their potential life needs and what are their cash value opportunity, and you can address, do you want to address this with if you die, just term insurance, or when you die, or a combination? What generation they're in, how they prefer to talk, and then what potential pieces do we have for either checklists or calculators for them. And as they get older, so now let's say the client, excuse me, is 50, and now let's say their children now are between 13 and 21, and let's say they're in their pre-retirement, let's say they make 100 to 250. Now you see the needs change. Life insurance needs, cash value opportunities, and accelerated benefit chronic illness. Again, if you die, when you die type insurance, what their generation is, with preferred communication, and what tools you have. And what's really nice is when you hit Save Custom Report, it actually generates a report that you can save in a client's file that's in a PDF format. I'm just waiting for it to load. So once it loads, you have this PDF and you're going preparing to meet with Tom Brown. Here's his age, relationship, income, the basic data. What potential needs might they want to address? What generation are they in? And what are some of the cool tools for them? And again, the folks at Financial Brokerage can help you with this. I like to show it because it's a good tool that, again, goes right hand in hand with the butterfly chart. So one last thing I told Tim I'd talk about, and I'll let you go as you're probably getting hungry for lunch, and probably phones ringing, emails are coming in. All the carriers in the IUL space have updated their products for AG49A, and it's called AG49A Revised. And all it really did is it made that all the carriers have these volatility control index accounts. You'll see them; they'll be named after Fidelity or Merrill Lynch, or generally investment. They sound like mutual fund names, but they're actually accounts, index accounts that try to mitigate risk of the S&P and give you more of a levelized performance in the index universal life products. While there were some games that were being played and being a little bit abusive on how well companies could illustrate those compared to the S&P 500, we were very conservative, so we didn't have a huge difference between our Merrill Lynch account, let's say, and our S&P 500. Some carriers had big differences. So the NEIC came out with a revision that said, okay, all the accounts have to illustrate the same as the S&P level as S&P 500. So they're all going to look the same. Well, what that means to you is you're going to see carriers that when you're running maximum rates, they're going to be all different because carriers had to adjust to that. And because we're what's called a new money rate, that we follow the interest rates more closely, and we've been one of the first in the volatility control index market, we can now illustrate better than most of our competitors at a higher rate of return. Other carriers have had to diminish their rate of return. But that said, the products didn't change. It was just how they illustrate change. So if you run everybody to level 5%, everybody should illustrate the same pre and post AG49A for the most part, because their products didn't change. But illustration-wise, if you run max rates, you're going to see a carrier like us, we can illustrate all the way up to almost 7%, where other carriers can only issue maybe 5.25%. That's all they can illustrate for now. So due to these changes, you'll just notice some changes in how carriers illustrate, but it really didn't change how their product performs. Just wanted to share that with you. The folks at Financial Brokerage can give you more details on that, but I just want to make you aware of that it wasn't really a product change, it was an illustration change. So that's what's going on for the industry. So everybody had to be compliant for that starting May 1st. So that's something I just want to make you aware of. So with that, I'm going to stop sharing my screen. I think this is right here. And open up to any questions, thoughts, anything I didn't cover, Tim, anything else you wanted me to mention or show. And one last thing I would say to take away from this, if you're at your computer now, I would definitely write down retirestronger.com, no www, and on that page, it gets you access to all the content I just showed you. If you need direct links to anything, we also have an advanced market site on retirestronger.com. If you need any access to that, just email Tim and he can get it to you, or you can ping me and I'll send it to him. So with that, I thank you for your time and turn it over back to Tim and see if there's any questions.
Thank you, Tom. Appreciate that. Very educational as always. Just a reminder to everybody, if you do have a question or comment, just go ahead and throw it in that question field on the right-hand side of your screen. I'll see those come through. Also, a reminder on those handouts that are attached on the right-hand side of your screen. And another plug for the Retire Stronger website that Tom showed. Those handouts come directly from that website. So you can download them now quick and also find a wealth of materials and resources just like those on the Retire Stronger website that Tom shared. Tom, I was thinking as we were going through the presentation, and I've obviously been familiar with the concept, but maybe something new to comment on the financial risk side in retirement is bank failure. As unfortunately, we're seeing more and more regional banks no longer be a safe place to keep your money. So obviously, there's some protections in place, and hopefully no clients or consumers are ever totally damaged from any of those bank failures, but it is becoming a thing to be aware of and something that your clients are certainly seeing on the news. So something to talk about there as well. Maybe a quick question, Tom, just so everybody knows. Um, that may or may not have seen the name Corebridge Financial up to this point. I mean, I think
Sure.
we've been communicating and made people aware, but not everything gets out to everybody. And so if people might be much more familiar with AIG than Corebridge Financial at this
Sure.
point. Maybe you can talk about what Corebridge Financial is and the relationship with AIG.
Sure. We're really just a new color. That's why I'm wearing this. We're now purple. If you see here, I'll pull up my card. We're now on our cards. We're all purple on the back, but really, it's pretty simple. So I think in these days, all the companies are becoming more and more focused. So if you look in the industry, all the companies that were commercial and general insurance, property casualty insurance that own life and retirement and life and annuity companies have all divested. They've all spun out. So if you look at Prudential and Hartford and Travelers, MetLife, all those companies, Allstate, have all separated those units because I think a lot of the synergies that you had from owning a life and annuity company and a PC, I think they used to be more cyclical in the property casualty world with, with all the climate, whatever side of politics you believe on climate, it's just definitely more volatile, no matter what the reason is behind it. It might just be because it happens, but it's more volatile. So things are always going on versus certain times of the year. It used to seem more periodic, right? Storms are always in September, August to October, and fires are a certain time of year. Now it's all over the place. There's always something going on. And also a lot of the analysts for the stock companies in particular, there's very few that were focused both on life and annuity and retirement type products and general insurance products. So it's just harder and harder to be valued as a company when you didn't have analysts that specialize in both of those, even though the company was saying they're diversified. So what we did is we had our unit. So if you look at AIG, they bought American General years ago. And then they turned American General over time into AIG Life and Retirement, which is a division under AIG. That was our life brokerage division. It was our AIG Direct division. It was our small PPGA division. It was all our annuities, both fixed, immediate, index, and variable annuity companies. It was VALIC in the TSA marketplace. All those different companies became AIG Life and Retirement, but we're under AIG, so we just say AIG. Well, then in 2020, they decided it was AIG's turn to the best Corebridge or to best us from AIG Life and Retirement from AIG. So in October of last year is when we were IPO, did an initial public offering. We had to come up with a new name, and there's so many names are taken out there. So we came up with Corebridge, which is core values and a bridge to the future. That's our focus. And we basically took all of AIG Life and Retirement and just moved it outside of AIG, became Corebridge Financial. We're still on American General paper, so I think that's interesting. So we have all the products are with us because in some prior divestitures, the parent company had all the products, tools, technology, and the company that got divested had to start from scratch. Us, we kept American General, we kept all the tools and all the people and resources spun out. And we're still anywhere on the rankings on the annuity side, we're somewhere in the 2 to 5 ranking, depending on immediate, fixed, all those type of annuities of all carriers. And on the life side, I think we're number 6 or 7 in term. We're top 10 in life insurance written. I think in the UL, just because of some changes and things that we've had over time with COVID, I think we're in the top 15 there. So we're a sizable company overall. I think we're the 9th largest, somewhere in that 8th, 9th largest life and annuity company. So it's not like we're just some small potatoes, wildlife of Kentucky size company out there. And for all intents and purposes, the product names are the same reinsurance, the same retention, the same underwriting, the same manuals, everything's all the same. We're just Corebridge Financial. And then for right now, AIG owns 77.5% of us, to be exact. And over time, they will divest us and we'll be completely standalone. But for right now, they still are a majority stock owner of Corebridge Financial. And they want to do everything they can to make us as successful as possible because if we win, they win. If we lose, they lose. So that's why everything's been good. And, everything for the most part is business as usual. And that's why you see a lot of the pieces still say AIG with Corebridge on it and that type of stuff. And eventually it'll all be Corebridge. But really it's just been business as usual. Nothing's really changed other than we're doing like most carriers. Just to digress off of that, is we're going to more and more automated type underwriting, especially for your bread and butter. You know, what's going to happen, you know, give it a few more years, but pretty soon, anybody that's under 50 that's looking for under $1 million, it's all going to be automated, and it's going to be, here's your offer. The bad news is the old days of haggling with the underwriter on those type of cases are going to go. It's just going to be what the computer says. So what's happening is the computer is saying, okay, we don't need your fluids. We don't need your medical records. We're going to take what the client puts on their, you know, quote part B list of questions, and then we're going to ping these databases like medical claims, electronic health records, MIB, credit reports, all that. Look at that data and go, boom, here are your preferred, your standard. So it's a lot different than, hey, we looked at your lab profile and we looked at your 2 doctors' records and that. It's a different type of underwriting, but we're all trying to make it more transactional instead of taking 30 to 90 days, or trying to make it take, you know, anywhere from 45 minutes to 5 days. So we're trying to make it a faster process.
Great. So, you know, bottom line on the Corebridge thing, obviously, new color, new logo, same products, same service, same team. So not much has changed from that perspective, but it's good to be aware of that relationship for everybody. Yeah. We do not have any other new questions coming in. Last thing that I'll mention is, obviously, you know, I'll assume that everybody on the presentation got a great understanding of presenting permanent life insurance as a protection tool for somebody's entire life, not just during their working years. And so you'll need good quality permanent products to choose from. So as you have those cases coming up, give Financial Brokerage a call. We can certainly educate you on Corebridge's product lineup, what the unique advantages are there, and how those products work, best way to present them to your clients. And then with that, I'll leave you until next time. As always, we'll have webinars consistently coming up, most of the time on Wednesdays, and you'll be communicated those the same way via email, social media, however you found this today. Appreciate everybody's time. Special thank you to Tom as well. Thanks for taking the time out and educating us on the butterfly chart and the other concepts.
Yeah, and the biggest thing I say is take it back and find those 3 names, because so many people see these ideas and they go, that's great. And then 3 weeks later, they're going, we talked about butterflies or something. What did we talk about? And they don't remember. Or if you actually try and put this in and try to find those 3 names on Who Do You Know or the butterfly chart or both, it can turn into some quick revenue going, and then you'll find how easy it is to put it into your practice. So I highly recommend, like the batting average, right? Try 3 and try it and try adding it into the practice and work with you guys.
Thanks, Tom. Thanks, everybody. Enjoy the rest of your Wednesday.
Take care.